Today's PCE data mainly in line with expectations, though the Fed's preferred inflation gauge, so-called core PCE, rose, driven primarily by services spending. And this comes after the GDP data came in higher than anticipated. So how can investors weigh that mixed picture of the data, especially as we are ahead of the Federal Reserve's July decision coming up next week? Joining us to discuss, we've got Thierry Wizman. He's Macquarie Group's global FX and rate strategist. And we've also got Ryan Wang. He is HSBC's US economist. Thanks both for being here this morning. Ryan, I'm going to kick it off with you because I didn't even mention consumer sentiment data. So a lot of data coming in about this economy. What is the data point that you are looking at specifically to clarify the Federal Reserve's next moves?
Thanks a lot for having me. Well, I think what happened actually this week is that most of the most relevant information for Fed policy actually came yesterday with the second quarter GDP report. And in the end, what we saw was that growth in the second quarter and really for the first half of 2024 as a whole has come in a little bit more resilient than anticipated. Once again, repeating a pattern we've seen in recent years. Inflation, I would say overall, is conforming to expectations. Yes, today's number was a little bit more elevated than perhaps the Fed would like to see, but you're still looking at a year-over-year core PCE rate of 2.6%, and that is still a low for this cycle and significantly lower than 1 or 2 years ago.
Thierry, what's your takeaway just in terms of what this means in terms of sentiment for the risk trade, how that ultimately impacts the FX market, and then ultimately, I guess, just determining the direction that we could see just given some of this uncertainty and back and forth?
Yeah, so I think one of the most unusual things about what markets have to deal with now is that the Fed does look like it's getting closer to a rate cut, most likely at the September meeting, certainly unlikely to be delivered at next week's meeting. And I think for a lot of financial market participants, the idea of Fed rate cuts is sort of inherently associated with weak economic growth, maybe even recession fears. I guess what's different this time around is that's really not the backdrop that we have. Instead, what we have is inflation that was very high 2 years ago. It's come down considerably, but you have an economy that continues to outperform. So I think markets are having a hard time trying to deal with what this actually means for the outlook over the year ahead.
Thierry, what do you think? Do you agree?
Well, look, if you're asking about how risk takers are approaching things right now, I think the sentiment here has been dominated in the last few days, not by necessarily what the Fed is going to do, although that is important, but really what's been happening with corporate earnings guidance, which has not been very good in the United States or in Europe. And I think if it were not for the prospect that the Fed is going to start easing, presumably in September, you would have seen a lot more risk-off sentiment prevail in the marketplace in the last few days. I think one of the things that is holding up sentiment, despite the fact that we have signs of a slowdown in the May and June data cycle in the US and with respect to the corporate earnings cycle, is the fact that the Fed is going to be cutting this year, as are other central banks around the world.
Thierry, I want to stick with you for a second because I read in your note that you sent over to us this morning that you mentioned the picture that we're getting that's kind of mixed given some of the earnings data alongside the macroeconomic data. What is the bigger driving factor for you? And do you think that, do you think the Federal Reserve might be missing something here if they don't look at the earnings data that we're getting in, which does appear to be kind of mixed so far?
If it was only the earnings data that was looking a little poorer recently, then it's very possible the Fed, as macro watchers, could have been missing something. But it's not just the corporate earnings data that's been coming in softer. Certainly, we've had the labor market data in the U.S. come in softer as well. So, for example, initial claims 20% higher at this point than they were at their trough. Continuing claims 30% higher than they were at their trough. These are signs that the labor market is slowing down, and given that maintaining full employment is an important mandate of the Fed, I think that they would have been watching that certainly. And by the way, if it were only 2 months of low inflation that we had seen, I would not be, nor would my colleagues be, calling for the Fed to be cutting as early as September. It's not just that inflation has come down from where it was in the first quarter and the early part of the second quarter. It's also that we've gotten some weakening, some loosening, if you will, in the labor market. That is the thing that has accelerated the prospect that the Fed will be cutting rates.
Ryan, we have seen some weakening, some loosening, some softening, like Thierry just mentioned there, within the labor market. But Balancing this risk, though, of moving too quickly, how real is that risk still? Is that risk still on the table if the Fed were to move in September, that it would be jumping the gun just a little bit?
Well, yeah, I think there has been signals in the labor market that certainly compared to 2 years ago, there's less labor market imbalance. There's not such a big disparity between labor demand and labor supply. And perhaps the clearest sign of this has been the gradual drift higher in the unemployment rate, up to 4.1% in the June data. And that's up from a low of 3.4% a little over a year ago. That is very interesting. And historically speaking, it's also quite rare to see a drift higher in the unemployment rate. Typically, it's either not rising at all or it's spiking higher and really giving rise to recession concerns. So I think that's relevant. I think it does show that the kind of the incremental change in the labor market might be shifting. But I think for Fed policymakers, they're still not considering the current economy a scenario where the labor market is necessarily deteriorating more rapidly than they expected. And so what that means is that the Fed may deliver some rate cuts, but I don't think at this stage the Fed is prepared to move aggressively because the labor market overall is still evolving in a kind of incremental fashion.
So Thierry, then to put a button on this, I mean, is this, it sounds a lot like Goldilocks to me. I was going to ask you, is a rate cut in September potentially about preventing weakness, a reaction to weakness from the Fed, or is it just the best case scenario, a Goldilocks move?
It could be both or all three. The Fed has to be, to some extent, anticipatory. If it weren't, they really couldn't call themselves economists. I mean, one of the jobs that policy economists do is try to look at the data, but also try to extrapolate from the data what is going to happen so that they stay, effectively in front of the hockey puck. I think what we're seeing now is a trend towards weakening. It's not an aggressive trend. I think what we've done is we've moved from above trend growth in the US to trend growth. That's really the major shift that we've seen in the last few months. It should not be terrifying to the Fed, but if they're anticipating what will happen in the event that they do not cut, I think what they would see is further slowing to below that trend, and that's why they're going to try to preempt that with a cut. Let's be very clear here. Every recession that has taken place in the US usually starts with growth above trend. It then moves to a level that's a little bit more on trend and Goldilocks before it finally breaks below trend if the Fed is too late, if the Fed makes a policy error by not cutting aggressively enough. We saw that in 2006 and 2007. The Fed kept rates high for long, for about a year, which is exactly how long they've kept it high this time. But then when they started to cut, in some way, it was too late. You had a recession by the end of 2007. They certainly wouldn't want to repeat that.
All right, Thierry Wizman, Macquarie Group's global FX and rate strategist, and our thanks to Ryan Wang, HSBC's U.S. economist. Thanks to you both for hopping on with us here for today's panel.